The impact of smart contracts on financial transactions in the evolving world of digital technology. One of the most groundbreaking innovations to emerge in recent years is the concept of smart contracts. These self-executing contracts with the terms of the agreement directly written into lines of code have the potential to revolutionize the way financial transactions are executed. Smart contracts, built primarily on blockchain technology, offer a decentralized and automated way to handle financial agreements without the need for intermediaries. This video delves into the profound impact smart contracts are having on financial transactions, from reducing costs and increasing efficiency to enhancing security and improving transparency in ways that were once unimaginable. To understand the impact of smart contracts, it is essential to first define what they are and how they work. A smart contract is a computer program that automatically enforces and executes the terms of a contract once predefined conditions are met. These conditions are written directly into the code, and the contract is deployed on a blockchain network. When both parties to the contract fulfill their obligations, the smart contract automatically executes the agreed-upon action, such as the transfer of assets, payment, or delivery of services. Since smart contracts are stored on blockchain networks, they benefit from the security, immutability, and transparency that come with decentralized ledger systems. The result is an agreement that requires little to no intervention from third-party entities such as lawyers, banks, or notaries. One of the most significant benefits of smart contracts in financial transactions is the reduction of intermediaries. Traditionally, financial transactions often require intermediaries like banks, brokers, payment processors, and legal professionals to ensure that all terms are adhered to and that the transfer of funds or assets is completed securely. Each of these intermediaries charges fees, which increase the overall cost of the transaction and slow down the process. Smart contracts eliminate the need for these middlemen by directly connecting the two parties in a secure and automated environment. This disintermediation not only reduces transaction costs but also speeds up the process, making transactions faster and more efficient. For instance, in the case of international money transfers, smart contracts can eliminate the delays associated with bank processing times, currency conversions, and intermediary banking institutions, enabling cross-border payments to be completed in a matter of minutes rather than days. Furthermore, smart contracts provide a new level of security in financial transactions. The decentralized nature of blockchain technology ensures that the contract is stored across multiple nodes in the network, making it highly resistant to tampering or hacking. Once a smart contract is deployed, it cannot be altered or changed by any party, ensuring that the terms of the agreement are enforced as written. This immutability reduces the risk of fraud or manipulation, which is a critical concern in traditional financial systems. In addition, smart contracts use advanced cryptographic techniques to protect sensitive data and transactions, further enhancing security and privacy. Smart contracts also enhance transparency in financial transactions. In traditional financial systems, many aspects of a transaction, such as fees, processing times, and the terms of agreements, are often opaque and not easily accessible to all parties involved. With smart contracts, the terms of the agreement are written into the code, and once deployed on the blockchain, they are publicly visible to all participants in the network. This transparency ensures that both parties have access to the same information, reducing the chances of misunderstandings or disputes. It also promotes accountability, as any attempt to alter the terms of the contract would be easily detectable on the blockchain. One area where smart contracts are making a significant impact is in the realm of financial services and lending. Traditionally, lending and borrowing agreements involve complex paperwork, credit checks, legal procedures, and often lengthy approval processes. Smart contracts streamline this process by automating the terms and conditions of the loan. For instance, in decentralized finance, DeFi, platforms, borrowers and lenders can enter into smart contract agreements that specify the loan amount, interest rate, and repayment schedule. Once the borrower fulfills the terms of the loan, the smart contract automatically releases the funds. If the borrower fails to repay on time, the contract can automatically trigger penalties, such as the seizure of collateral. This automation reduces the need for manual intervention, speeds up the lending process, and increases the efficiency of the entire system. Moreover, smart contracts are reshaping the world of securities and asset management. In traditional financial markets, securities, such as stocks, bonds, and commodities, are bought and sold through intermediaries like stock exchanges, brokers, and custodians. This process can be time-consuming and expensive due to the involvement of multiple parties and regulatory requirements. By using smart contracts, securities can be tokenized, meaning they are represented as digital tokens on a blockchain. These tokenized securities can be bought, sold, and transferred directly between parties without the need for intermediaries. Smart contracts automatically execute these transactions based on the predefined terms, such as the transfer of ownership or payment. The result is a faster, more efficient, and less costly way to trade and manage assets. One of the key advantages of smart contracts in securities trading is the ability to create programmable assets. Programmable assets are digital representations of traditional securities that can be programmed with specific conditions and actions. For example, a smart contract governing a tokenized stock could automatically trigger a dividend payment when certain conditions are met, such as when the company reaches a specific revenue threshold. Programmable assets have the potential to unlock new financial products and create more customized investment opportunities, making the financial markets more dynamic and accessible. Smart contracts also offer significant advantages in the insurance industry. Traditionally, insurance claims require extensive documentation, verification, and approval from various parties, which can lead to delays and disputes. By implementing smart contracts, insurance companies can automate claims processing, making it faster and more efficient. For example, in the case of flight delay insurance, a smart contract could be programmed to automatically trigger a payout when a flight is delayed by a specified amount of time. The smart contract would access data from external sources, such as flight tracking services, to verify the delay, and then automatically execute the payment to the policyholder. This automation reduces administrative overhead, speeds up claims processing, and minimizes the potential for fraud. In addition to traditional financial services, smart contracts are playing a significant role in the emerging field of decentralized finance, DeFi. DeFi refers to financial services that are built on blockchain networks, which allow for peer-to-peer transactions without the need for intermediaries. Smart contracts are the backbone of DeFi platforms, enabling users to borrow, lend, trade, and earn interest on their digital assets without relying on traditional banks or financial institutions. For example, users can lend their cryptocurrency to others through decentralized lending platforms, with the terms of the loan, including interest rates and collateral requirements, automatically enforced by smart contracts. DeFi is expanding the possibilities for financial inclusion by providing access to financial services to people who are unbanked or underbanked, as these services are accessible through an internet connection and do not require a traditional bank account. Despite the many advantages of smart contracts, they are not without challenges. One of the primary concerns is the issue of code vulnerability. While blockchain technology is generally considered secure, smart contracts are only as secure as the code they are written with. If there are bugs or vulnerabilities in the code, malicious actors could exploit them to manipulate the contract or steal funds. As a result, it is essential for developers to rigorously test and audit smart contracts before they are deployed on the blockchain. Additionally, smart contracts often rely on external data sources, known as oracles, to trigger certain actions. If the oracle providing the data is compromised, it could result in incorrect or fraudulent execution of the contract. Another challenge is the legal recognition of smart contracts. While smart contracts are gaining traction in the tech community, their legal status remains unclear in many jurisdictions. Governments and regulatory bodies are still working to determine how to recognize and enforce smart contracts in the traditional legal system. Until clear legal frameworks are established, there may be uncertainty about how smart contracts will be treated in case of disputes or breaches. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go.